Welcome to Slides with Sebold Capital. My name is Sean Sebold. I'm founder and president of Sebold Capital Management. Today we're going to talk about the Tax Cut and Jobs Act of 2017 and how that's going to impact things moving forward. So let's take a quick look at what we're doing here and how this is going to impact planning moving forward. So the Tax Cut and Jobs Act of 2017 is the current income tax law, estate tax law. So there's lots of components in it that we have to deal with. Many people, because it's been so long, don't realize that because this passed through the Senate and it did not have 60 votes, the Byrd rule applied, which means that it has a 10-year sunset provision. So normally when you do that, the Congress wants to get it made permanent somewhere within those 10 years. However, because we've had divided government, that has not been an option. So let's see what the ramifications of that are going to be. So first, will it stay or will it go? So my answer to this is we'll talk in November. Depends on if we have divided government. Generally, with divided government, you're probably not going to get Republicans and Democrats to agree on, gee, let's have this move forward. This was a rather contentious bill when it was passed. So this is really going to be who's going to control. Is it going to be the Democrats? Is it going to be the Republicans in November? Less about the executive branch, i.e. the presidency, more about House and Senate. So if we have a divided House, the House is, so if it stays the way it is, the House is controlled by the Republicans, the Senate is controlled by the Democrats. Again, will they agree on something as big as a large tax cut bill? The presidency has less of an impact on that, really going to be Congress. So stay tuned on this. There are some things that are happening right now with regards to legislation on some of these issues. But wholesale, we don't know what's going to happen until after that election. That'll give us a little bit better idea as to what's going to stay and what's going to go. Okay, what are some of the components of it? So first, income tax. So a lot of this bill is income tax, and again, most people say, well, this is just permanent, right? Well, no, actually, it goes away in 2025. So the Tax Cut and Jobs Act actually lowered the top tax rate from 39.6 down to 37. So that's an impact. Standard deductions will be reduced if it does get sunsetted. There will be no more salt. So we're certainly not talking about salt on your steaks. We're talking about the state and local taxes. Current law says the maximum that you can write off on your federal tax return for state and local taxes is $10,000. This impacts mostly high income tax and property tax states such as California, Illinois, New Jersey, New York. So if that SALT cap is eliminated, obviously that's going to be a benefit to taxpayers in those particular states. Mortgage and home equity lines. Currently, the cap is 750. That would, of course, go back up to $1 million. Home equity lines, there would be a more liberal ability to write off the interest expense for home equity lines. Miscellaneous itemized deductions beyond the 2% of AGI, they were drastically reduced under this code. That they would also come back. The personal exemptions, however, would also reduce. So, and the PEAS limitations would come back. So the PEAS limitations are if you have a lot of deductions, high deductions, and your income is very high, what happens is your deductions then get reduced by about 3% per each different income level. So that will also have an impact. Child tax credit also would get reduced. However, they're currently talking about increasing this. There's bipartisan agreement that they want to increase the child tax credit. So that actually might not be a part of this sunset provision. QBI, which is a qualified business income deduction. This is a very large component of this bill. Anybody with a small business, S Corp, LLC, gets pretty good sized deductions as a result of this. So if this is to sunset, small business and business in this area is going to pay a significantly higher income tax rate because that deduction will go away. AMT, also known as alternative minimum tax, because of some of the deduction levels have been increased, AMT has not really been an impact on most people over the past 8 years or so because you just didn't have the deductions. Your standard deduction was higher. So that also could come back into play from an income tax perspective. Charitable deductions, they're doing a little bit of changes there, mostly on the cash side, so it doesn't have a big impact, but it has a little bit. Casualty losses. So prior to this, in order to, you could write off your casualty losses if you had a casualty deduction. After the Tax Cut and Jobs Act of 2017, you had to make sure it was a federal casualty, so a presidential determination of a casualty in order to write that off. QOF, what's next on those? So these are qualified opportunity funds and qualified opportunity zones. So they were essentially to encourage investors to come to urban areas to help out in certain spots that were deemed qualified. These were 10-year investments. So are these going to continue to work going forward? The people in the qualified opportunity funds, do they have to stay in those? So there's a lot of unknowns with regards to what's going to happen with regards to qualified opportunity funds. That's on the income tax level. On the transfer tax level, so transfer tax is gift tax and estate tax. So in 2024, our federal exemption limit is $13 million if you file jointly or you're married, 27 million. So effectively what that means is you do not pay estate taxes if your estate is below the value of $27 million. Okay. So what's going to happen if this sunsets? It's going to reduce to approximately 7. And the reason we say approximately, because the way that it's going to happen is it's going to go back to 5 million in 2017, and then they have to gross it up for inflation. So we're estimating it's going to go to around $7 million, which means that if you now have an estate with married filing jointly of 14 million, you will be subject to estate taxes. So at the 27 million, not a lot of people. At the 14 million, we could be getting there, especially with the inflationary issues. If we're selling a business and we're getting some pretty good multiples on those, it could have an impact on your estate taxes. So something to concern ourselves with. Annual exclusion has been increased to 18,000. Of course, that would also be looked at, and effectively what that means is each individual can give 18,000 to as many people as they want any given year without having to file a gift tax return or a 706 on their taxes. Okay, so what's proposed? So the Green Book is essentially the current administration's budget plan. Now, these are not laws, but these are things that they want to put in the budget that they want to try and get implemented within their administrative cycle. So what this does is it gives us kind of a vision as to what is currently being looked at. We do need to raise revenue. We have a lot of debt in the United States. So these are some of the things that have been proposed. Again, they're not law, but it gives us some kind of idea which way we're going. So transfers between certain trusts right now that are not taxable, they're looking to become taxable. That is going to be a really big issue with regards to grantor trusts and moving things out of those. Intentionally defective trusts, this is also another estate planning mechanism to move assets out of an estate and then pay the taxes on those assets. That effect would go away in the current Green Book rules. Grantor retained annuity trusts also would be gone. Valuation discounts. So if we're transferring assets into a vehicle that we want to then get a discount because it's a minority interest, those are going to be curtailed and limited to market value and privately held companies as opposed to marketable securities. Step up in basis also is potentially going to go away. Annual exclusion, the current proposal within the Green Book is 50,000 per donor. I just talked about 18,000 you could give away to as many people as you wanted. So if you had 10 grandchildren and you wanted to give 18,000 each, that's $180,000. The Green Book is proposing you are capped at 50. It doesn't matter who you give it to, but you're capped at 50 per donor per year. Again, not in there, but that's proposed. GST exemptions also would go away. And there's also a proposal by Senator Wyden that is in the Green Book that basically says we're going to pay a tax on any gains in assets, whether they're privately held or publicly held. There's some questions to whether that will pass constitutional muster, but again, it's in the Green Book. So what does this give us from a planning perspective? So planning opportunities over the next couple of years, gift, see if we can get money out of estates, out of taxable estates into the next generation and get any kind of appreciation out. Use planning now. There's lots of effective tools that do still work, at least will continue to work until changes are made. I've got GRATs on here, which is grantor retained annuity trusts. IDGTs are intentionally defective grantor trusts. QPERTs, qualified personal residence trusts. These are all tools that do work in terms of getting assets outside of a taxable estate. Other, pay tax today. So if you pay tax today instead of sometime in the future, then you are going to get a pretty good sized discount. So for example, if you donate or if you give away $1 million and you are now in the point that you're going to be paying gift tax on that, if you give away $1 million, then you pay $400,000 in your transfer tax. You've essentially taken $1.4 million out of your estate and paid $400,000 in transfer tax. Whereas if you wait and the next generation pays estate tax on $1.4 million, instead of paying $400,000, they're going to pay $560,000. So paying tax today actually is a pretty effective tool if we do have a taxable estate. Don't split gifts, another good tool, making sure that we're going to use up that extra $7 million of exemption. That's a very good thing. Portability, if we do have a death of a spouse, we want to make sure that we're filing the 706 and we take their lifetime exemption and not let it completely go away. We do have a 5-year window on that, so plenty of time to handle portability issues. Bill basis upstream. So we've talked to this with some clients, upstream planning, general powers of appointment. So this will enable us to, upon death, we will get a step up in basis in any appreciated stock or security. There's a lot of good planning. Again, that stuff may go away if this tax sunsets. So it's something that we want to think about right now. Spousal lifetime access trusts, also known as SLATs, are also a very effective tool getting assets outside one side of the estate. And something we do quite a lot of are Roth conversions. Roth conversions can take potential tax, bring it into a lower tax year. If taxes do go up in the future, you're certainly going to want to pay a lower rate today than be subject to higher tax rates in the future. So there's our 5 slides for today. Thanks for being here. Really appreciate it. If you want to find us, you can find us on the web at seboldcapital.com. You can send us an email at info@seboldcapital.com, or the old-fashioned way, give us a call, 630-548-9700. Happy to talk to you. Thanks. Take care.